Ryan serves as the managing partner and team lead at Sierra Pacific Wealth Management. Previously, Ryan served as senior vice president and senior portfolio manager and team lead of the Sierra Pacific Group at Morgan Stanley. Ryan started his career in wealth management industry at Edward Jones, where he grew to be the largest producer in the country for his length of service. In 2020, Ryan was named to the Forbes Top 20 Best in State Wealth Advisors for Nevada. He has over 12 years of industry experience and is a certified financial planner, holding Series 7 and Series 66 licenses, as well as all lines of insurance. He's quite the expert. Prior to the wealth management industry, Ryan spent 12 years on active duty as a naval aviator, where he logged nearly 3,000 flight hours and 256 carrier landings. Ryan fully retired honorably from the United States Navy in 2017. Ryan graduated from Trinity University in San Antonio, Texas, with a BS in finance and economics. Then he was smart and moved to California and the Lake Tahoe region. He has a BS, as I said, in finance and economics, and he went on to complete his graduate work at Harvard Business School, where he is an active member of the HBS Alumni Association. Ryan has been giving presentations for the UCSD Retirement Association for over 12 years. He is part of our special cadre of preferred professional providers, who are people we consider to be the best in their field and who give excellent community service presentations for our members. Each month, Ryan presents a new topic for our monthly investment interest group, and they are, of course, on the fourth Tuesday of every month from 12 to 1. So today is one of those investment interest groups. Ryan, take it away.
Thank you, Suzanne. Can you hear me okay? I'm testing.
Certainly can. Thank you.
Okay, am I coming through loud and clear? I just wanted to test
Yes.
a new audio here so I can not doing it through my phone. Welcome everyone from a very, very cold Lake Tahoe. I just checked the current temperature. It's 26 degrees. We had about 10 inches of snow overnight, and so it's quite cold. I'm pretty much wishing I was in San Diego right now. So I have, enlarge my screen here if I can. There we go. Built out a presentation today about tax efficient investing and giving you some different ideas, charitable giving, et cetera, et cetera. But I think the elephant in the room is exactly what's going on in the news right now. I'm watching the market here. We're rebounding off the lows. If anybody watched the futures yesterday and overnight, since markets were closed yesterday, at one point the NASDAQ was down 4% overnight. And the Dow was down almost 600 points overnight, and we rebound quite significantly since then. So if you think about today and you see red on your screen, I could tell you it was going to be a lot worse as the overnight was occurring. And of course, all the news is breaking about Russia and Vladimir Putin's speech yesterday and all these other things happening. So I think probably the best thing to do would be to address some of the geopolitical concerns real quick. I also, in the chat, am going to put a link for those of you. This is kind of different. I'm putting a link here because the Wells Fargo Investment Institute is holding a call right after this. So I will jump off this a little early. I sent this out to all of our clients earlier today, and those of you that are on our distribution list. But if you want to hear what the actual investment professionals at the highest level think about the current situation and the current news, these are always great to tune into. It's at 1:15 Pacific. I'm giving you the dial-in code and the passcode there, so you can join that as you please. Excuse me, I've got a little bit of something in my throat. So anyhow, let's, and the other thing I wanted to mention real quick is Wednesday. March is a very busy month for me, UCSD. We have Social Security 1 and 2 coming up, and then the Medicare presentation and another investment interest group. So I'll be around 4 times in March. I encourage you, if you have not already, excuse me, to join us for Social Security 1 and 2. because it actually has ramifications when it comes to tax smart investing. So with that, let's go ahead and jump into the slides here. We'll talk about some geopolitical concerns that are constantly changing here, especially over the weekend, and then we'll move into the actual presentation. Next slide. And as always, I'll do my best to monitor the chat here so that if you have any questions, I can go ahead and jump on it. Remember, these presentations are for you. And so I'm here to answer any questions as we go along. So a couple of key takeaways, and realize these notes that were produced for us and our team from our research group came out on either Wednesday or Thursday of last week. And obviously things have changed vastly since then, but continue to escalate in Eastern Europe. Putin ordered his military for the weekend, as we all know, to be ready to wage war, to basically an invasion. This is a significant increase in the risk. You may have just seen President Biden's speech where he just announced the first round of sanctions, of course, what they're calling the first tranche of sanctions on Russian banks, et cetera, et cetera. Next slide. So what does this mean? Well, for investors, quite frankly, that means bring the money back here to the US. It's going to be the safest spot for your money moving forward. May be hard to imagine that, but the US stock market is considered the most safe of all of the world stock markets, right? If you go out the risk scale, emerging markets being the riskiest, developed international market second, and then the US market's considered the safe haven market of stock market, equity markets. And of course, US treasuries are considered the safe haven of the world. And so that's why I say when I say, to reiterate, our preference again is going to be for equities, and you'll see here commodities, right? And you saw oil spiking today, another 2% up from the close last Friday. And we favor these, both equities and commodities, especially now over fixed income, because underlying all of this geopolitical stuff that's dominating your TV right now, we have to keep our eye on the ball that we are moving into a rising interest rate environment. The Fed has turned off the spigot. We're no longer easing. We are going to be drawing down on on monetary stimulus. And that means that fixed income and bonds, or commonly known as bonds, are not going to do nearly as well moving forward for possibly the next half a decade to a decade as interest rates rise, and in particular in the near term as we see inflation pressures. Again, we'll talk today a little bit about municipal bonds and tax-free investing, but I want you to also keep in mind when inflation is running 7% was the last reading, but when it's running into 3 to 5% range, and your bond yields are maybe in the 2% range or 1% range, you have to remember that that's what's called a negative real rate of return, meaning your rate of return is less than inflation, which means you're essentially throwing that difference into the fire, right? If you have CDs out there, if you have money market, this is quite frankly a very, very difficult time for both of those investments, because we're at the end of the easing cycle, which means those rates are still incredibly low, but yet we have these inflationary pressures, which are turning money market and cash into a very negative real rate of return. Next slide. So just to finish up on the geopolitical stuff, next slide, please. So again, what is Russia trying to do? This could be applying a NATO strategy that they've been using in Ukraine for a decade. They are very concerned that Ukraine would join NATO and basically become a larger or closer part to the West, right? And that is not acceptable to the Russian government. One reason for maintaining our base scenario is that Russia could leave a large force Ukrainian border to discourage Ukraine from joining NATO, but without incurring the cost of a full-scale invasion. When I say full-scale, sending troops in as peacekeeping force, as he said yesterday, into the eastern parts of Ukraine is not the full-scale invasion. If you recall, Russia got itself in a decade-long war in the 90s in Afghanistan, and those memories are still near and dear to a lot of the people in Russia. That was a very costly war, an insurgency, and you're likely to see something similar in Ukraine if they were to completely occupy the entire nation or to take it over by force. Next slide, and we'll go through some of the different scenarios that we see here. All right, so they could support separatists in southern Ukraine. It looks like that's the route that they've taken so far, right? Two separatist regions. Encourage the autonomy of Donbass and political divisions across Ukraine, basically, through cyber attacks, through supporting the rebels, the rebels that are already sympathetic to the Russian cause. They could create discord or distrust in the Ukrainian government, which could, of course, lead to a collapse of the government in Ukraine, which would be definitely one of the end goals. Essentially try to discourage the West from and NATO from reaching out to Ukraine and sow divisions within the NATO alliance, essentially giving Russia a larger challenge to NATO. You may have seen over the weekend, the Finnish government, which of course borders on a very long border with Russia, came out and said that they would ask for NATO membership if Russia were to full-scale invade Ukraine. So, there are other countries in Europe specifically that do not see this as the way the U.S. does. And so we have a lot of support from our Western allies, even in the eastern parts of Europe. Next slide. So again, just the potential economic and investment implications. There's a little direct trade between Russia and the world outside of Europe. Russia is a large supplier of natural gas and energy to mostly Europe. Fortunately, here in the U.S., there's really not much of an effect, of Russia, other than the geopolitical instability that we'll see in the markets. Our biggest concern and fear here in the United States, of course, is the expansion of the Russian Empire through Eastern Europe, and then where does it stop from there? As far as the economy, Ukraine is a very, very small economy, right? So from a global perspective, very unlikely to start any type of recession or domino effect throughout European countries. What we're seeing on a more local level within portfolios is emerging markets, right, which are going to have exposure to Russia, right? Remember, we think of emerging markets sometimes. We look at like BRIC, Brazil, Russia, India, China. China, not so much an emerging market anymore, but it's still the largest component within emerging market funds typically. Russia is certainly a part of that as well. So you're going to see those emerging market funds take big hits. My encouragement for you, if you're managing your own portfolio or working with a professional, is to consider taking what are called tax loss harvesting. This is a presentation about taxes and being tax efficient. This is exactly something you may want to do right now. Let's say you have a fund that's down 10, 15% in emerging markets. You don't want to abandon emerging markets now, because what you're saying is, hey, look, we're going to go down more. This is going to get worse. But more likely than not, most of the downside risk has been priced in. So what you should be looking to do is potentially do a tax swap within those funds. You may want to switch out to an ETF that mirrors the entire emerging market or the European Union, and hold that ETF for the next 31 days, and then you can come right back to the fund that you like, or stick with the ETF if you prefer. Anyways, definitely some time to begin looking at some tax loss harvesting options within emerging markets and developed international markets. Next slide. I think I covered most of this, so let's go to the next slide. And again, just to reiterate, when it comes to what we're seeing geopolitically, it's really time to favor the U.S. Again, Home Depot today announced an increase in its dividend of 15%, right? So Home Depot, what exposure does a company like Home Depot with a wonderful dividend, a large cap U.S. company, have to a Russian invasion of Ukraine? So that's how you need to be thinking about your investments right now and where you're placed. All right, next slide. Let's get into the actual presentation today. So what we're going to do is we're going to talk about tax savings questions that you can ask yourself. And these are the 5 that I'll go ahead and discuss today and reference as we go through some different options for you. So should you defer compensation, right? Meaning, do we want to put money away today that gives us a tax break and defer it, let it grow tax deferred, and then take it out at a later date? And why do we do that? What do we think about when we are doing that? Should you choose investments that offer tax deferral, right? There doesn't just have to be within a qualified account like a 403B or a 457 or a 401k. There are actual investments that you can go out and buy that give you tax deferral as well. Can you change the tax character of the income you receive, right? Well, that's referencing more, if I own a fund or I own an ETF or own stocks, do they have qualified dividends or ordinary dividends? Are they, how are they paying me to own that particular stock, or they're not paying at all? Is it purely a growth stock? Well, you could change the income or the way you receive your income by buying things that are preferential to preferential income. And how about the timing of gain recognition, and how does it affect your tax bill? We'll go through some of those. And then what is the most tax efficient way to make charitable gifts? Okay, so next slide. And you'll be receiving at the end of the presentation here, you'll actually receive this handout that I've cut and pasted a bunch of these different techniques, or this entire slideshow basically is built off of the handout that'll be sent at the end of this. So some strategies that allow you to defer compensation. As I've just mentioned, you have an IRA, a 401k, and a SEP, right? There are income limits on all of the, well, more so on the IRA side, but a 401k, 403b, same thing, right? 457. You have an opportunity, particularly at UCSD, to participate in both the 403b and 457. If you are retired and you're not eligible to take RMDs, you're not 72, and you have income, right? You can potentially contribute to a SEP if you own your own business. If you're a W-2 employee and you don't have a 401k plan, maybe you can contribute to an IRA. This, of course, boosts your retirement savings. And most importantly, what it does, it gives you what's called an above the line deduction on your taxes, right? On your 1040. When I say above the line, I mean above adjusted gross income, which a lot of different things are determined based on your adjusted gross income. And so that deduction gives you a dollar for dollar deduction on your tax bill, right? So, I encourage you to look up, there's a handout that was given out at the beginning of this that has all the different contribution limits and amounts. And if you have any questions about, particular contributions to IRA, SEPs, and all that stuff, you can certainly put it there in the chat box. But it reduces your net take-home pay, right? And if contribute to a non-Roth account will increase the taxable required minimum distribution in the future that you're going to have to take out of that. The thing is, for most people, is that you're going to make a lot more while you're working than you will when you're taking RMDs in retirement. Okay. And by the way, it does not avoid the 0.9 Medicare surtax, right? That unlimited Medicare surtax on any earned income. So what else can you do? Well, the next one, we can enroll or increase contributions to a non-qualified deferred compensation plan. So many of you do not probably have that here at UCSD, but for those of you that have joined that maybe have a husband or wife or some type of spouse that works at a local company, you have a deferred compensation plan, you can consider just deferring some of your income to a later date. The only thing I would caution you on that is you really need to understand how that deferred compensation works, right? Is it a liability of the company? Am I giving up, what is the vesting schedule? How do I earn that deferred compensation back, or how is it paid out? You need to know all those different things, but it does lower your current spendable cash. You have to also remember that. It does not avoid the 0.9% Medicare surtax, and the non-qualified plan assets are subject to the claims of an employer's creditors, right? So if I worked for a very volatile biotech company in San Diego, I probably would not participate in the plan. On the other hand, if I worked at Qualcomm, I'm not very concerned about the company going under for some reason or going bankrupt, then I would probably be more apt to participate in a non-qualified deferred comp plan. The next one, again, applies to very, very few people probably on here, but manage the timely employer granted stock option exercises, right? And so many companies out there have different stock option plans that can be vested at different time, or the actual options, the exercises can be done at different time. I'm not going to really go into that because I know that's not really applicable to most people here. Next slide. And so here are some tax deferred investments that you may want to go to. One of the ones that's commonly overlooked, and some people just think of the word annuity as a bad word in general, right? But it's really not, especially if you are someone who does not like risk very much, right? You don't need current income. You can certainly buy an immediate annuity, but it doesn't give you a tax benefit, say. But a deferred annuity, the money that you put into that annuity is very similar to an IRA. Now, you don't get a deduction, right? So it's after-tax money, but it grows tax deferred. And then when you pull the money out of an annuity, depending on how it's structured and the facets of the annuity, which is why you need to learn all the different concepts and have a financial professional hopefully explain them to you. You have a potential very tax advantageous withdrawal in retirement from your annuity. Okay, they can be pretty complex investments, so it's something definitely you need to understand before you get into. Withdrawals prior to age 59 and a half, just like qualified plans, are subject to a penalty. They may have surrender charges. They may have front end loads. They may have time periods that you need to stay in them for some reason. And when you do take the money out, it could be subjected to the 3.8% Medicare tax, right? The Obamacare tax. Gains do not avoid taxation upon your death, right? Subject to ordinary income tax upon withdrawal. Well, and I should have a little star next to that, depending on what kind of contract you use. And at your death, you may result in little to no remainder for the heirs, just depending on how much you've taken out of it or how it's structured. So again, if I have any, one bit of advice when it comes to annuities, I would say that the biggest thing with annuities is they can be complex investments. You really, really need to know and understand all the facets. Now, I don't want you to be scared of annuities. I think there's a lot of good with annuities, right? Essentially, that is what your pension plan is an annuity, right? But you need to understand the facets of it before you get involved and lock up your money, right? So master limited partnerships, this is more of a advanced estate planning strategy. So I'm going to go ahead and skip that one, but you can certainly read about it when you get the handout if you'd like. Next slide. Another interesting one you may not have heard of, this is something that's kind of come about of late, are 529 college savings plans. And you may say, well, I don't need a 529 college savings plan. I'm already gone to school. I've graduated. I've got my degrees, this and that and the other. Well, one thing you can do is it can be like a super Roth. Okay, so you remember to achieve the tax benefit within a 529, simply the funds must be used for a qualified educational expense. So let me give you some examples of qualified educational expenses. Flying lessons, wine tasting events in France, right? You go to official wine tasting or somewhere where you're out there learning about different types of wines in the Burgundy region of France. Guess what? You could use your 529 to fund your travel, your room and board, the school that you go to for to learn about different wines. Now, that's something you definitely would want to discuss with your CPA ahead of time, right? To ensure that it's considered a qualified educational expense. But I can tell you there's a lot of leniency on those qualified educational expenses, especially when it comes to 529. So next one you probably already know about or heard about are tax managed mutual funds or ETFs, right? This is just simply an ETF that's generally designed to have a lower turnover of the underlying assets. Sometimes I think people go out and buy mutual funds, and one of the things they overlook are these gains distributions that they'll potentially buy into the fund, and then suddenly that's big cap gain because of a distribution within the fund, and they've only owned the fund for a month or two, right? So when you're doing your research on your ETFs or your mutual funds, if you're doing your own research, make sure you understand what the tax ramifications of a distribution when it comes towards the end of the year might be, right? And remember, tax efficiency does not necessarily guarantee better performance, but the less turnover they have in these funds often means that you're going to have less of a taxable 1099 at the end of the year, right? So next investment vehicle we have is life. Nope, go back to that prior slide there. Life insurance with cash value. Not usually my favorite vehicle, especially for a group like this. I've used life insurance with cash value as a tax deferral strategy, but when I've used it, it's been for people that make obscene amounts of money. Last time I did one of these, a gentleman I was working with, making about 15 million a year. He needed life insurance anyhow for wealth transfer. Yes, I did say he was making 15 million a year, and he needed that for wealth transfer anyhow. So what we did is we overstuffed the life insurance, something called a variable life insurance policy that the underlying investments were in the market in mutual funds with an insurance wrapper around it, so that all of the gains were tax deferred. Now that worked out really well in his situation because he had a lot of extra, free cash flow, but not necessarily a good investment for somebody that's in retirement or at retirement. He was also a young executive in his early 40s at the time. Next slide. So can you change the tax character of income received? So just a quick review here of how we characterize, tax income. First of all, the net investment income tax, which is we commonly refer to as the Obamacare tax, the surtax that was created in 2013, right? It's taxable interest, dividends and net capital gains, and taxable non-qualified annuity distributions, rents and royalties received as passive income, and passive income from partnerships, including master limited partnerships, right? So, for a single taxpayer, this is over 200,000 in adjusted gross income and 250,000 for a couple. And then you can start adding on that 3.8%, Obamacare tax to all of your investment, net investment income, right? Net investment income, what does it not include? So again, this is for higher income folks. It does not include tax exempt interest from municipal bonds, right? Distributions from IRAs and employment retirement plans, right? So when you are taking out those RMDs, you don't have to worry about the net investment income tax. Income from an active trade or business and veteran and Social Security benefits. One of the most tax efficient things you can do, and that's why I encourage you to come to the Social Security presentation, is to understand how beneficial your Social Security benefit is versus taking down or withdrawing IRA benefits, right? One of the main reasons is because if you take $10,000 out of your IRA, let's say in the form of an RMD or just in a distribution, right? You're going to pay not only federal income tax on it, but you're going to pay state income tax on that withdrawal. Social Security in the state of California is not taxed at the state level, right? So it is tax free at the state level. So it makes it a much more valuable dollar than a dollar distribution from your 403B or your 457 IRA, which is why I'm a big proponent of delaying Social Security and maxing out that benefit during your 60s while you draw down on your other your qualified assets, meaning your IRA, 403B, 457, et cetera, et cetera. Next slide. All right, so a couple different investment techniques we can have here. We can invest in tax-exempt bonds, right? It's excluded from the Medicare surtax calculation, federal income tax, right? But remember, first of all, municipal bonds, tax-exempt bonds, right, are very low in yield right now, 1% maybe. And so you have to think about that, real rate of return on the interest you're getting. Yes, they're fairly safe, and yes, they're fairly attractive in a high tax environment, especially like California. But you do have to keep in mind, if your net real rate of return is significantly below zero, it may not be the best investment, right? You got to check your muni bonds as well. Not all muni bonds are the same. Some are subject to AMT if you're in a higher tax bracket. You got to remember, if you're receiving Social Security, the interest you do receive on tax-exempt bonds does go into the calculation for the taxation of your benefits, right? It's included in what's called MAGI, or modified adjusted gross income, and it is subject to the calculations on Medicare Part B and D for what's called the income-related monthly adjustment. So if you pay a higher Medicare Part B and D premium because you're in a higher tax bracket, investing in tax-exempt bonds does not help you avoid that, right? That's where some type of deferred annuity is much more helpful than investing in tax-exempt bonds. Below that, we got consider growth-oriented stocks for part of your portfolio. Right now, value stocks are doing significantly better than growth, so I'd be very careful on what type of growth stocks I'm buying into, especially on the technology side. I don't know if you guys know this, but in the middle of this correction we're in right now, the median NASDAQ, so the NASDAQ right now is down about 17% from top to bottom during this correction, right? The NASDAQ, right? Which is the most aggressive of the three indexes. If you think of the Dow and the S&P 500 and NASDAQ, much more technology and growth oriented. So the NASDAQ is down about 16%. The median NASDAQ stock right now is down 40%. We are literally experiencing a very similar dynamic, not quite as severe, but a similar dynamic that we had in March of 2000 through the bottom in 2002, which is when we saw growth and particularly high-flying technology stocks with very little earnings get absolutely crushed. I could give you some examples of companies that you probably heard of: Peloton, Robinhood, right? Beyond Meat. All three of those companies I just mentioned, stocks are down 70 to 80% from top to bottom. Certainly losses you cannot sustain when you're in retirement, right? The high flyers of last year, I encourage you to look at some of the GameStops, the AMCs, to see what they're doing, right? All the meme stocks, all this stuff that was chasing. You have to think about how the environment has changed, right? We've gone from an environment where the Fed is throwing so much money into the system. And quite frankly, not only was the Fed throwing money at everything, but fiscally, our federal government was throwing money at everything as well, over $1 trillion, right, in stimulus. So those two combinations of stimulus flood the market with liquidity and flood the market with a bunch of money that that needs to be allocated, but with little opportunities to allocate. So that's how you get two things. That's how you get a market that's up 28% for the year, right, with earnings that didn't come close to keeping up to that. And that's also how you get rampant inflation in real assets. I say rampant inflation. If anyone saw the numbers that came out in the Wall Street Journal this morning, housing was up the highest percentage year over year in 2021 I think it was either 37 or 38, nearly 40 years, the highest increase in housing. I know many of us here in the San Diego area have probably experienced a doubling of our house prices in the last 3 to 4 or 5 years. That is not normal. Real estate normally trends, even in Southern California, on a trend line of about 5 to 7% year over year, because it's considered not quite as risky as investing in stocks or equities, right? So you get a little lower return, but getting a return in the high 30% range in 1 year is obviously crazy. Just to give you, insight on some other markets. My wife and I bought our house here in Tahoe, this one that I'm in right now, in 2018 at $330 a square foot, and it would now sell for $1,200 a square foot. And all the buyers here are all cash buyers. So think about nearly a quadruple in roughly 4 years. And where are we getting all of our demand from? Literally all the demand is coming from the Bay Area, and they're all cash buyers. And the average house now in Incline Village, when we moved here in 2015, I think the median house price was 550 or 600,000. Now the median home price here in Incline Village is 2.4 million, which is crazy to think of when you're in a town of 9,000 people. That's at 6,500 feet. It snows half the year. So anyhow, obviously inflationary pressures significantly hurt, and things. Inflationary pressures affect real assets the most. That's why we've seen such a rapid climb in the stock market. And you may see I don't want to say a reversal in the housing market like you have had in the stock market recently, but I think you could definitely see a flattening out of increases in housing prices, because the median housing price cannot be so much further above the incomes of that local area. And especially when interest rates start rising on mortgages, it makes housing significantly less affordable. Next slide. Next slide, please. There we go. All right. So a couple other things. Converting traditional SEP or simple IRAs to Roth IRA. This is one, and I know it's here on the slide because this, slides are for, across the U.S. One of the rules of thumb that I'll give you in California is if your income, is anywhere over 75,000, this is not usually a strategy I recommend, because you have to pay ordinary income tax on all the conversion, both at the federal and state level. And because here in California, we have such a progressive state income tax, it is often not advisable. Think about if you have to pay 25% in taxes on a $100,000 conversion, right? And 25% by federal and state, right? What return do you need to get on your Roth to get to the same level? You need a 33% return, right? If you have to pay upwards of a 33% tax penalty to move it from a traditional IRA to a Roth IRA, you need a 50% return to get back to even, right? So I think you need to be mindful of the fact that because we're in such a progressively taxed state, that oftentimes a traditional IRA conversion to a Roth IRA is probably not the best deal. There's a bunch of calculators out there on the internet that you can use to find out where a crossover or break even is. And I would encourage you to use one of those or speak to a financial professional if you're thinking of doing that. Choice of business entities, not really applicable to this group, so now probably not a lot of business owners here. And a careful review of whether your business activities are characterized as passive or non-passive. Again, I probably don't have any business owners on here, so I'll go ahead and skip that for now. Next slide. So how will the timing of gain recognition affect your tax bill, right? So this is one of the probably the most overlooked parts of investment management that we see, especially on the self-do-it side. And what do I mean by that? Again, as I said at the beginning of the presentation here, you need to be taking opportunities in these corrections. It's not time to move to cash. It's not time to, the time to move to cash was, a month ago, right? Or even before that, a month and a half ago. You have to understand in these downturns, right? It's actually the time to take advantage of being able to reallocate and or take what are called tax swaps or tax losses, right? So selling an appreciated long-term concentrated stock position, this is a time where we would maybe start doing that, right? And reallocating capital because we're looking at less of a tax burden for the person that has a very concentrated position. Another strategy we'll talk about here in a second is we potentially would be selling what are called covered calls or call options. We'd be short call options against a stock position. And as the market falls like it is right now, we're taking profits, but we're also selling out some of the stock as well as it goes down and using the profits from the option position to pay the tax bill on the stock, right? Again, just things that you can do in these markets as they are falling. But I think the biggest thing is seriously look at your portfolio and consider what are called tax swaps, right? You have to remember there's the wash sale rule that if you hold a security for 30 days or less, then the capital loss that you've captured will be wiped away, right? It's washed away. That's what's called the wash sale rule. You need to hold it for 31 days, and then you can go back into the security you had before, or you could just stay with the new security if you like, but you at least get to realize that tax loss, okay? So think about doing that, especially maybe on some of your short-term capital gains. Some other techniques here that affect your tax bill: business or property installment sale. Remember that, if you go and sell a property, right, even if it's your primary residence, especially here in San Diego, let's say you bought it for $500,000 in the 90s and now you're selling it for $1.5 million, right? Remember, if you're married filing joint and you've been in the house for at least 2 of the last 5 years of your primary residence, you're going to get a $500,000 exclusion on that capital gain. It's also very important to have your tax records and everything in order, because maybe you put a new fence in, maybe you painted the house multiple times. That brings up what's called your basis. So you buy the house for $500,000, you put all these improvements in it and everything. Let's say it's another $200,000. You need to bring your basis up to $700,000. So instead of selling it for $1 million capital gain and paying $500,000 in capital gains taxes because you get the $500 exclusion, if you get the basis up to $700,000, right now you have an $800,000 capital gain. $500,000 is excluded because you're married filing joint, and now you only have a $300,000 gain to pay taxes on versus a $500,000 gain. So think about things like that, especially when you're selling a residence. Next slide. One of the things I missed on the very last of that slide we'll talk about here in a second is a charitable remainder trust. Many of you are probably charitably inclined. I encourage you, if you've never heard of that term, charitable remainder trust, there's several different types. There's a CRAT and a CRUT, right? So charitable remainder annuity trust and a charitable remainder unit trust. These are just ways that we can use gifting and get an immediate tax break, right? And then sell an asset, let's say a highly appreciated rental property. We can sell it in a charitable remainder trust and not pay capital gains, keep all of that. It has to stay in the trust. The trust eventually goes to a charity of some sort, and we get an immediate tax break as well, and potentially income for life. You have a highly appreciated property, or you have highly appreciated stock and concentrated stock in a company. If you have any type of asset, let's say it's land, you can put all of those into a charitable remainder trust and not pay any tax on the gain of the sale at the time of the sale, as long as there's a charity that's the beneficiary at the end of the trust, meaning at the end of your life, and you could take income potentially off of that. We do that often. We do these charitable remainder trusts, depending on the market, depending on advisement from attorneys, whether we do annuity trust or unit trust. Something I can go over if you have questions. I've got a couple different handouts on the different type of trust, and that's definitely something you can look at. Another option for property, real property, is what are called like-kind exchanges. Many of you have probably heard of what's called a 1031 exchange. If you have a rental property, you can 1031 exchange that rental property. One of the things on a 1031 that you cannot do is you cannot exchange your primary residence, right? That's why you get that $250,000 or $500,000 exclusion. There's some new products out there today that are really interesting. If you do have several rental properties, where you can do what are called these Delaware statutory trusts, where if you don't want to exchange the property and be a property owner and manage the property, going into retirement, one of the options you can do is go into one of these Delaware statutory trusts where it's all taken care of for you. And of course, you're going to give up some stuff for that, but maybe you just want the income for life and you don't want to have to deal with property management because you're at the point where you want to exit being a property manager. If you have questions on something like that, please send me an email or a message. Qualified opportunity fund investments, right? These are newer, these qualified opportunity zones. I'm not going to really go much into them because these are very, very long investments, but a lot of very, very wealthy clients like these, but they're 10, 12 years in length. If you have any questions on it, you can also send me an email. Next slide. So what's the most tax efficient way to make a charitable gift, right? So let's look at the different techniques and then go through how you get the deduction, right? And then we'll finish up with just a couple more strategies, okay? So gift of cash, right? It's simple and flexible form giving. Charitable deduction offsets up to 100% of your adjusted gross income. So cash up to 100% of your adjusted gross income, right? It's much less for some other different stuff. Like for example, for a donor advised fund, 60% of your AGI, 30% for private foundations. The 100% offset applies to 2020 and 2021 only. I'm not sure exactly how 2022 is going to pan out yet, but something you can certainly ask your CPA about. You got to itemize the benefit from a charitable deduction of more than $300 in 2020 and 2021, right? It's increased to $600 for $25 in 2021. A favorite of some of my clients is the gift of appreciated stock, right? You get an income deduction allowed in the amount of fair market value of the stock if held more than 1 year. and the taxpayer avoids income tax on the embedded gain in the stock, right? So let's say I have, a ton of shares of Qualcomm and I want to donate to my local charity. I can, as long as I've held it for over a year, I can donate 50,000. I get a $50,000 deduction. So I don't have to pay any capital gains taxes on that gift of that stock, right? Income tax deduction for gift stock held 1 year or less is generally limited to the basis of stock. Just remember that. Next slide. Qualified charitable distribution, right? So this is if you have an IRA, right? You got to be 70 and a half or older, right, to exclude this from your income, but up to 100,000, right? You don't get a current income tax deduction, but you don't pay any taxes whatsoever on an IRA distribution, right? I know this is a favorite of many of my UCSD clients. Once we've rolled over the 403B and 457 into an IRA, and they have a large IRA, and they've got, RMDs every year, right? Required minimum distributions that start at 72. Often they'll take a portion of their distribution and send it straight to a charitable organization, and therefore they don't have to pay ordinary income tax at the federal or state level on that distribution. That goes straight to the charity of their choice. Right? Another technique is gift upon death by naming a charity as beneficiary of your IRAs, annuities, or employer retirement plans. Remember, the assets avoid income tax upon distribution to a charity, and the asset avoids estate taxation if you are in that level of estate tax potentially, right? And no income tax deduction during lifetime of death, but the assets will not be available for heirs. So that's something you have to consider in light of your current income situation and what you're looking to do. Next slide. All right, so just a quick review here, right? Different tax efficient strategies that we've discussed and things that you can think about as you go through your retirement, right? Tax loss harvesting throughout the year. Again, if there's something that you could do immediately and do right now that is going to be beneficial, that tax loss harvesting or doing those swaps, as I said, this is the time of year you want to do it. Okay. Use a covered call option strategy on highly appreciated stock or large single stock positions. I should add into that, if you want to donate to your charitable organization, just donate stock directly to them, or the proceeds from the sale of stock directly to them. That is another way to be very efficient with your highly appreciated stock. Tax efficient investments. Yes, we talked about municipal bonds. We talked about ETFs and mutual funds that have a tax efficient mandate. You may want to look at something like that. Tax deferral through insurance products. I mentioned that life insurance is not normally my favorite, but I do a lot of annuities, especially for folks that do not have pension plans. Oftentimes we'll look at a 20 to 33, 35% of their investable net worth into some type of annuity product, because it does give them that guaranteed income stream for life. There's not a lot of risk within them, as long as you are well educated on the different facets of the annuity and you know how it works. And then again, as we discussed at the end, gifting, I would look at, certainly those of you that are charitably inclined, I would look, if you have highly appreciated assets like a home or land or even stock, please take a look at what a charitable remainder trust is and how that can really help you reduce your potential exposure to taxes today and benefit your charity at death and provide you an income stream from now until death. Next slide. With that, yep, we're all done. So right on time at 12:45, 12:46. I'm going to open it up for any questions or concerns. Everything's fair game here. If you want to talk about the geopolitical stuff, I'm kind of been monitoring it here on my phone as I've been watching you guys. I also, again, if you go up to the top of the chat, if you wanted to hear from the investment professionals that we listen to, which is at the Wells Fargo Investment Institute, that call starts in exactly 30 minutes. The dial-in is there, or passcode's there if you wanted to hear what they have to say about the current situation in Ukraine and how we see that as an investment thesis going forward.